Welcome to the weekly update, where I'll go over the action in the market for the week of April 1st through the 5th, and then we'll see how things look for the week of April 8th through the 12th. For the first time in a number of weeks, we actually had a down week. Now, it could have been a lot worse. The big down day was on Thursday, and that really produced an over percent drop, one of the largest drops we've seen. It was also a day that we saw above average volume. But then the employment report came out on Friday. The market took that as friendly, and we were able to recoup a lot of the losses that we saw on Thursday. On the daily charts, when we take everything together, we are at a tipping point right now. We could go up from here, we could go down. Of course, you could say that any day, but the charts are kind of converging with each other, saying that, okay, we could justify going down from here. We could also justify going up from here. So let's go through the weekly charts and see what we come up with here. Before I get started, please know that I post videos every day, and those videos that I post each day are really the backbone of my analysis. I know my videos are longer. I know I post more videos, and quite honestly, I make those videos longer on purpose to weed out all the folks that are looking for quick answers. Because if you really want to be successful at this, it takes some analysis and it takes some experience and it takes looking at a lot of different things and putting all the pieces together. You're not going to find that with just one or two indicators. In my many decades of doing this, that's the conclusion that I've reached. And since reaching that conclusion is what really changed things over for me. So please, if you want to see things on a day in and day out basis, check out the daily videos. Also, I'm posting some program launch videos. I have a whole program where I have more pre-recorded classes that I teach, well over 100 hours of instruction that shows you the theory behind everything. And then I use the daily, weekly videos to show you, okay, this is how this is being played out in real-time conditions. I have some videos on the YouTube channel as well as Rumble, just explaining what my program is. I'm going to be posting more videos about that. It's quite involved, and if it's something you are interested in, please feel free to check out those videos, and there will be more to come. Also, there is a PDF available in every video that I post. I like the idea that folks download this. They like looking at the slides. They like looking at the charts. You might find that helpful to you. Also, the last video that's now become part of the staple, which for right now is a weekly video, I thought about updating it after Thursday, but then when we had the nice little bounce after Friday, I thought, okay, I'm just going to wait and look at everything in the big picture and then do this video. This is where I pick out what I'm really watching right now. It'll at least be once a week. I keep saying it's on an as-needed basis that it will be updated, but so far I haven't had a need to really update it more than once a week. There's also a thing called pivot points that I post on the YouTube community chat tab. I can't do that on Rumble. And if you click over on YouTube, every day I have pivot points that last for the whole month, and then I have another chart that are pivot points that are just applicable to that trading day. They change every day. I do have a private Facebook group. Not a lot of activity in that group. Another video that I'm thinking of doing is more of some feedback of how I'm going to launch the program. And one of the things I'm thinking of doing is how can we interact better with each other, either by having more of a bulletin board type system or a community area where you can post charts, you can text, you can write messages, and then also have a live session where you can actually come in and voice some questions or go over something good, go over something bad. And that may end up replacing the private Facebook group. But if you want to join that, there's not a lot of activity there. I pretty much just post whenever I upload a video. Also, I'll be going through the results of the latest poll, and then I'll be putting out a new poll for the upcoming week. And I'm still playing whack-a-mole like crazy on Rumble. I'm getting 2 or 3 comments a day that I have to delete. There's some big wave going through that if you take this webinar, you can become a YouTube expert and some type of helper to people out there. And that you can be like a consultant or something. And a whole lot of people must have taken this class. And in this class, they said, go through Rumble and just add these copied and pasted comments into Rumble. I'm not really finding them so much on YouTube. So that's what they're targeting. I delete those. If somebody wants to contact me, number one, I'm not looking for that. Number two, I have an email address at the end of the video. And if they tell me, what a great video, what a wonderful channel, but they don't email me, that tells me they're not even watching the video. So how can they tell me it's great? Also, I do post on YouTube and Rumble. Sometimes I have some problems uploading. That's kind of hit or miss. I'll go weeks, even months at a time and not have any problems. Other times, it seems like it takes forever to upload to either platform. And here is the link. If you can't find me on YouTube and you think, well, it's about time, there should be a video here, jump over and see if you can find it on Rumble and vice versa. All right, let's go back and talk about what happened. We were down 0.95% for the week. Not a major pullback, but still a down week nonetheless. We were below average with volume taken all together. The only above average day was Thursday, as I mentioned. All the other days are below average. The technicals, we're still looking positive. The bigger picture is still quite positive for right now. In some areas, we're looking a little too positive. In some areas, we're starting to show some weakness. And it's about this inflation and interest rate scenario. The market has pretty much taken on this Goldilocks attitude that the economy is not too hot, not too cold, and backed up by what the Fed has said, that they're probably going to have 3 rate cuts in 2024. Well, we're seeing a series of economic reports coming out like CPI, PPI. We're going to get CPI in the upcoming week and PPI as well. And then Jerome Powell comments from the Fed. Then we had this thing that kind of got thrown in the middle where the ISM non-manufacturing came in stronger than expected. The employment situation report was taken as positive, but still it's showing some growth. And now the market's like, let's rethink this a little bit. And then there were some comments this past week coming out of Fed officials saying that, well, we might not even cut rates at all. So, and that's the game that we play as things work themselves out. As far as our trend, we're still in a strengthening trend. We're getting kind of extreme with that reading, and I'll show you that chart. We're positive, even though the green line came down a little bit this past week with the decline that we saw, we're still positive in the bigger picture. All right, so here's some bullet points. Stocks were down for the week after a very strong first quarter. Some of that can be expected. We did have just a stellar quarter. After having a very strong fourth quarter in 2023, some folks maybe wanted to lock in some profits. We were also very extended in the short and intermediate and somewhat to the long term, and stocks are becoming a little too positive. Sentiment was getting a little positive. So the idea that we're due for some kind of a pullback, that's not necessarily a mystery. It's when things start to pull back, that's when we have to evaluate things. Is this just a pullback? To this point, that's what it looks like. Is it going to turn into more of a decline? If the decline gains strength, is it going to turn into more of a correction where we're looking at 7, 8, 9, 10% of a decline before we finally bounce? So far, things are holding. Interest rates and the US dollar were up. That did pressure stocks this past week. Interest rates just keep going up because of these strong economic reports, and the dollar's seeing some strength now where the stock market typically likes a weaker dollar. Then last Friday, a week ago, which was Good Friday, the PCE price indexes, that came in as expected. And this is what the market used to have a nice Easter weekend. And then the economic reports that came out this past week, it shows an ongoing strengthening in the economy. And that's okay as long as it doesn't get too okay. Then that throws this whole interest rate idea into check. Then Minneapolis Fed President Kashkari, who's no longer a voter, these were the comments that really sparked things on Thursday, said that it's possible that maybe the Fed might not cut rates this year if the progress that's being made to get back down to that 2% level for inflation, if that doesn't end up happening. And so that threw the market into a bit of a tizzy, which still may result in more of a tizzy after this, but we just go as things are played out each day. Geopolitical tensions. This is driving up oil. Now, as I say in the daily videos, oil can rise if that means that the oil companies are making more money. What is the context for oil rising? There's some issues between Iran and Israel. Of course, there's issues all over the Middle East, but this is pushing oil up. That's more geopolitical. That's more unsettled things that are happening. And when oil rises for that reason, that tends to be negative for the markets. Earnings season is going to be starting at the end of this upcoming week. Banks will be reporting. They're usually the first to really kick off earnings season. This is a chart that I've been showing for almost a year now, and it's a very long-term chart where the blue area goes from 1966 to 1982, and then the orange area was where we were as of about a year ago, but we're still headed down. We're kind of mirroring along this blue line here with a declining inflation. And as I said a week ago, somebody posted an update of this and really was just posting information and just got hammered. Just so it's like, okay, all right. But the concern that I have from this chart is not that we're declining right now. It's what might happen after this. We don't know what's going to happen. We could break away from this model at any time, and we could just go sideways with inflation, or we might even continue to go down. But just know that after inflation was looking good, then things in the mid to late 70s got pretty dicey there for a while. And we saw inflation really going up before the early 80s or so was when inflation started to come back down. We have no idea if it's going to play out like that. Everybody will give you an opinion. We have to follow the charts and just make our decisions along the way. All right, we're also looking at this RenMac chart. We're above the 4.02% level with the 10-year yield. When we get above that, that could be biting into corporate profits. We closed at 4.33% on Friday with the 10-year yield. Here's the poll results. The first question, and on some computers, this question showed up, and other computers, it didn't. I don't know what's going on with this. Do you feel volume will pick up above average after the Easter holiday or continue to be below average? Well, there was only 3 people that voted, and everybody thought volume would pick up. It actually dropped off and is still below average. Do you feel that the extreme positive readings that we're seeing on numerous indicators at the same time? And that's why I look at multiple charts. We look for a consensus in our charts. Does this suggest that stocks are overbought or just showing solid upward momentum? 67% thought that we were overbought, and you can still make a case for that. We're kind of coming down. We're not seeing very many overbought indications right now on the daily charts. In fact, we've worked off that whole list. And for a while, up until probably this past week, it was looking like it was good upward momentum, but only 33% thought that. Then, do you feel that the economy is shifting to a new phase? This is what the market was trying to adopt from October into about the latter part of December, where we saw growth in value going up strong. We saw interest rates coming down. The market was convinced that the Fed was going to cut rates. And then everything got kind of switched around, and that's when the market ran into some problems at the beginning of 2024. Now the market's trying to shift back to that phase again. And with the folks that voted here, do you feel the economy is shifting to this new phase that might be more friendly ultimately to small caps? Since small caps are the laggards right now, and they have to borrow so much money, and they just are living earnings report to earnings report. That's why they're small caps. There's a lot of risk in these companies. Well, the friendlier environment actually benefiting small caps, 83% thought yes, 17% said no. Then, do you feel stocks have more room to go higher, or will they have a pullback? 89% thought that we were going to go up. We actually ended up going down. And right now, it's still just looking like a pullback. Some Isabel net charts. This is what I'm talking about with our scenario. And I've been going through this in pretty much all the different videos. If the Fed can come in and cut rates because of where things are at right now, that is what we call a slow cycle. And that would be more positive for stocks. It's just adjusting to what's going on in the economy. If the Fed has to come in and cut rates because of some catastrophe, some black swan event, something that wasn't foreseen that could really derail the economy, that is more negative. And if you think about it, that makes sense. And we don't know if these things are going to play out this way, but as long as we can ride this slow cycles, that would end up seeing an environment where interest rates can go down while stocks can still go up, where a lot of times the studies that I've done and I've read suggest just the opposite. We're looking at earnings going forward from here. All the projections are still looking up. That is positive for stocks. Then this is kind of a little bit funky. We have the US 10-year real rate that takes inflation into account, and then it's inverted. Okay, so they flipped it upside down and they're comparing it with gold. And basically what they're saying with this chart is that gold is discounting or building into the market a collapse or a decline in real rates, which could be beneficial for interest rates, which could also be beneficial for stocks. Then looking at the margins going forward out into the future, it does look like the earnings per share is these analyst projections are going to go up, and that's positive. And that also justifies higher stock prices. Then this is one of those charts where you could look at this and go, we might go into a recession. You see the red line here? When it really drops down below this other red line, the last couple of times, this grayed area, that's a recession. Well, we've really dropped down with this time, but now we're starting to go back up, and we have not hit a recession to date. Now, that could change, but you have most of the market now believing that we're not going to go into a recession or that we're going to have a soft landing. And this is kind of interesting. Back in 1994, this is when I really got started in the markets, and these were the big names at that time: Philip Morris, Sears, Mobil, IBM, GE, AT&T, and Walmart. And their market cap at that time, oh, and then you can see all the different capitalizations. Then you had Exxon, Ford, and GM. Those were the big ones. And it's like, I know Ford's not there. GM, these, I don't know about Exxon. I don't even think they're included in the Dow anymore. It used to be said what's good for GM is good for the country and all that stuff. This is what built the middle class, was the car industry. And now it's kind of a history lesson where now you have 2023 at the end of the year, we had 3.7 trillion in market cap, and these are all the big companies here. And let's see, Walmart's about the only one. I guess Exxon is still on here. Yeah, Chevron in its different forms. But it's kind of interesting how things have changed. All right, FactSet just had one blog post. They're getting geared up for earnings season, so they're just kind of putting their, conciliatory blog post up here. It says the second highest number, and I have to move this because there's a bar that you don't see. The highest number of S&P 500 companies are issuing negative earnings per share guidance since going back to 2019. And it's still pretty high, but it is lower than what it's been before. All right. Then getting into our charts. First, we look at an intraday chart. This goes all the way back to Monday, where it was kind of a slow day. We gapped lower and then went sideways on Tuesday. Wednesday, it looked like we were seeing a little bit of strength here. And then Thursday, this was the weird day. We actually gapped higher, went sideways. Then the comments came out from the Fed, from Kashkari, and we just kind of started drifting lower. And then this morphed into an all-out decline, closed right at the low for the day. It's like, oh my gosh, the world's falling apart. Well, this ended up being right at about the 50-day moving average for the NASDAQ 100. Then in Friday session, we were able to bounce up off of that and have a nice gain. So we were able to repair a lot of the losses in Friday session that we saw on Thursday. So for the week, and this is just the 5 trading days from Monday through Friday, all of the indexes ended up being down, with the Dow and the small caps being down the most. Going back to the beginning of the year, the small caps are now back to being negative, where all of the other indexes are positive. Looking at our sectors, this is sorted by what was down the most, since we had a down week, where we had healthcare, real estate, and discretionary Discretionary, this is a lot to do with Tesla. Real estate, since interest rates are going up, and healthcare, which is more of a defensive thing. That's why we're seeing more weakness in this area, where we had communication and energy, which is also coming back because of this tension that we're seeing in the Middle East. At least that could be part of the scenario. Now, this is sorted a little bit different. This is according to the Scooter score. The higher the score, the better looking that sector. We have energy, communication, industrials. They're all into the 90s. And when you drop down below 60, these are at the bottom here. I won't read them off, but these are all the, the weaker sectors right now. Looking at our relative rotation graph, we look up in the top right-hand corner. This is the plus with our X, Y axis. And we have the industrials doing the best, and then financials, which are pulling back a bit, but they're still looking pretty strong. Tech sector showing a little bit of weakness, where now we're seeing things like materials and even staples starting to show some improvement. And then way back here, which had been minus, is now showing a lot of improvement. Now, this goes back over a year. This is the energy sector. Then we look at different indexes, and I also go back 1 year and I compare it to the Wilshire 5000, which is another broad market measure that we use, where we still have the OEX, that's the S&P 100, the S&P 500, and the mid caps, which have really since the end of January have started to come on. The NASDAQ 100 is showing some weakness now. We're still kind of showing some weakness in other areas of the market, with utilities really picking up the rear right now. So looking at the sectors just for the 5 trading days that we had, there was energy, industrials, communication, materials, and utilities were up. The rest of the sectors ended up being down. Going back to the beginning of the year, we now have energy doing the best, followed by communication and industrials. The financials are still positive, and tech, with all of the other sectors being down year to date. Looking at sentiment, we came in with a reading at 61 after Friday's session. To give you some context, we had been at this 75 level, and that's showing good momentum, but it's also suggesting that we're getting a little too happy about things. And so now we're starting to see this coming back down. We could still go further than this, or we may bottom at some point if we say stay more positive, and could start to go back up. And we're not getting an extreme reading right now. Looking at the active asset managers, they had been really, really positive here, well above the 90 level, and now they're starting to pull back a little bit. Even though these folks are professionals, they're also human beings. They also have peer pressure. They also have quarterly statement pressure, and they end up sometimes chasing the winners too and getting in a little bit too late. That's why when we get extreme readings like this, we look at it as a contrarian indicator. Now, when it's going up, we can follow along with what they're doing. It's just when we get extreme positive or negative, when we start to look at, okay, look at other charts to see if we're going to start going in the other direction. Here's the VIX, which really spiked up with the down day that we saw on Thursday, and we broke this series of, well, we had come down. We broke this series of higher lows, and now we shot back up on the weekly chart with the VIX on the line chart. We were getting very low readings with the VIX, showing that there's just no fear. That spiked up this past week. The Ulcer Index is still giving us a really, really low reading, suggesting that there's not a lot of fear as measured by this indicator. And we're still getting pretty bullish readings here with the RIDEX bear bull ratio. When this goes up, that means folks are bearish. When this really comes down, that means they're bullish, and we're ticking back up. These folks tend to react to what's already happened, and they're still pretty bullish overall. And here's the active asset managers, a little different look at the chart, where it had been above the 100 level. Now we're getting a reading of 84.24. We did get the latest reading of Investors Intelligence. I know some people think that's an oxymoron. We came back up. Now, this is a week old, and it was updated on April 2nd, and we're at 4.43. That is a very high reading, and this could justify the market pulling back. The American Association, I always say that, the American Association of Individual Investors, they're still positive on things and not necessarily extreme positive. We also follow the 50-period moving average, which continues to go up and is not necessarily extreme. This crowd, of which that's us here, they tend to follow what's already happened too, but they're not necessarily getting too extreme, according to this survey. This is still looking positive. When the black line's going down, that means the tech sector is outperforming cash. Looking at some economic measures, we did get another estimate for GDP. We're coming in at about 2.5 now, according to the GDP Now forecast. When you look at the range of analysts, we're at about 2.5 to the upside and a little bit under 1% to the downside. This is what it looks like in bar format. We're still dealing with the fourth quarter. Now we're starting to project out what is it going to be for the first quarter of 2024. This is still looking healthy, although we're getting really low readings here. This is the spread between risky and not as risky bonds. When this spikes up, that's when the economy's freaking out. That's when we're really having some problems. This continues to decline. The latest reading of the Chicago financial conditions, we're still under this black line. That we only get nervous if we go above the black line. And then the percentage of the domestic bank and their tightening standards, this hasn't been updated since the first part of February. This is a quarterly report, so it's kind of hard. And my big complaint about Fed charts is, yeah, they tell you exactly what you should have done 3 months before you should have done it. So, but it's still helpful to look at these charts. This was updated, the real-time SOM recession indicator. We are coming up, but we're still under the red line. But this did come up from the previous reading. And then we also had the smooth recession. It's coming up a little bit above the black line, but we're still well below the red line. And the Brave Butters, we did get an update here on the 1st where it's still coming down a little bit. We were getting a little nervous as this line was going up. Now it continues to decline. Inflation, new quarter, so we're not getting much here in the inflation now casting. This will adjust as different economic reports come out. The Fed, right now, as of Friday's close, it's a 95.2% chance that the Fed's going to leave rates the same when they meet and make their announcement on May 1st. This is getting locked in more, where there was a little more doubt. The dark blue, that's the reading right now. This is where we're seeing some maneuvering. There's going to be another meeting on June 12th, and there's 50%, a little bit over, think that we're going to cut rates 0.25% there. And now this is starting to get a little bit more popular, where they might end up leaving rates unchanged. This shows you how this has changed, where it was a little more certain when you look at now, day ago, week ago, month ago. Now we're seeing this a little more certain popping up, meaning that they may not cut rates in June. Looking at the Fed balance sheet, we're watching this because there's been some hinting that the Fed is going to stop with their quantitative tapering. That means that this balance sheet, as this is going down, that's what quantitative tapering is. They're letting things fall off their balance sheet. They're not going out and buying more bonds. But there's some hint that they may actually come in and do some buying. It's not official policy yet. We just have to follow the charts to see what's happening. And this is where we're seeing a little bit, well, actually, when you look at the year-over-year basis, we're still declining. But if we start to see this going back up, and also in the previous chart, that means they're actually coming in and purchasing instead of just letting things drop off. And the market likes that, even though they promised they would never do it. Now it seems to be a way of life. All right, looking at our advanced decline line studies on the weekly chart, we're still looking good based on price and volume. We're also positive with our new highs. We're turning down a little bit with the 4-week moving average. We're also starting to decline with the 10 period. And that's not so much that new lows are expanding. It's more that new highs are contracting. The advanced decline ratio is still above 0 and going up. That's positive. The accumulation distribution, we're right about on the moving average on the daily chart. We're still looking good here on the weekly chart. Our trend, we are coming down with the green line. We're just a little bit above 40 with the ADX. That's when we're starting to get extreme. So we might be due for some kind of pullback or consolidation. And we are declining with the green line, and the red line is starting to come up, but it's going to take a while for these lines to cross. So this is still looking positive for right now. The Erin is also quite positive. We're above 0. We're seeing that the buyers, that's the green line, they're on top. The sellers are decreasing. The oscillator is the difference between the two. The mass index is not generating a signal. Then here's a daily chart where we fell down below this pivot point. We were able to come right back up and close it just above the 5,200 level in Friday's session. Then we look at the Keller market model in the short, intermediate, and long term. We're just looking negative with the small caps and the NASDAQ 100, where everything else is still looking positive. Here's another one looking across the market where stocks are positive, bonds are negative based on price because interest rates have been going up, commodities are still negative in the long term, and the dollar is in an uptrend across all the different time frames. And then here's the decision point scorecard where we're still down with the PMO. That's their short term. Intermediate term is up. Long term is down, where their trend models are positive across the board. Here's our trend channel. Still well above the midpoint, even though we fell back a little bit here. We're still looking pretty good. This is the chart that I've really been honing in on. This is the weekly chart of the S&P with the pivot points. We're still above this R1 level. We came up to it, we pulled back, we went above it, we came back. We're still above it for right now. This could potentially be an area of support if we fall. It's about the 5111, 5110 level or so, because we've seen this happen before. Back in 2021, we came right up to this pivot. Then 2022 happened. Then 2023, we came right up to this pivot. Then the fall of 2023 happened. Now we've been able to break above this and we're still above it. So that is still longer term positive. If we start to decline, we'll be watching this level. But when we look at the trend, the 50-period simple moving average, which equates to a 200-day moving average, the red line's going up and price is above the line and everything is still advancing. Our crossover is still showing that we're in a long-term uptrend. We actually are showing a little bit of weakness here. We dropped below zero with the McClellan oscillator, so that's slightly negative. And we're coming down after being extreme positive with the summation index based on price. We're still above zero, but we did decline based on volume. And we're dropping below zero now based on price and volume with the Swenlin trading oscillator. So this is some of the weakness longer term that could be creeping into the market. We're also coming down from 70 with the bullish percent index after we had been above and going up. Well, the momentum is now switched and it's starting to go down. So this is more negative. Now we could turn and go back up. Where it's really going to turn negative is if we drop below 50. Looking at our momentum, we're still looking good here. We're flatlining to slightly declining on the daily charts. We're still going up with the PMO on the weekly chart, but we're getting an extreme reading. We're still positive based on price, even though we came down, and volume has still been hanging in there a bit better on a daily basis. We did decline, but not as much as price did, and we're still positive with volume. We saw a bit of a decline here with the PMOs that are rising. We're declining with the buy signals. We're rolling over and seeing pretty much the same thing on the daily chart with the PMOs that are above zero, and they're still looking a little bit extreme positive. We're still looking okay here with the Bollinger Bands. We actually fell below the midpoint on the daily chart. We were able to get back above that on Friday, and we're still above the midpoint here on the weekly chart and the percent B, which measures if we go above or below the Bollinger Bands, we're not getting an extreme reading. So our momentum, we're still looking a little more negative with the slope. That's our shorter term oscillator. We're still looking good with the TSI. We're going up with the MACD, the PMO, PPO rolling over, but it's still positive. Our longer term oscillators, the TRIX and KST, still continue to be positive, but these are giving us very extreme positive readings. Chaikin money flow, turning a little bit more negative, started to switch over a little bit more positive on the daily chart. We're starting to roll over here a little bit here on the weekly chart. This is a smart money indicator. Chaikin oscillator, after getting really extreme, has now been coming down and is no longer extreme positive. The force index did decline a little bit, but it's still positive. We're also coming off of getting an extreme positive reading with the money flow index, where it's coming down slightly. The rate of change, we had a down week, so we're below the midpoint. Going back 50 weeks, we're above this red line. We're still positive here. We could go higher than this, but at the same time, this is an area where we want to be a little more cautious. The RSI is coming down, but still extreme positive. The weekly special K chart is still negative. It's still below the moving average, where the daily chart continues to be positive. The Stochc RSI is coming down after being extreme positive. Williams percent are still extreme positive, but now declining. Also coming down after giving us an extreme positive reading with the ultimate oscillator. And we're seeing some weakness in the daily chart with the vortex, where here we're seeing more of a decline, but it's still positive after being very extreme. The copy curve is negative both on the daily chart and here on the weekly chart. And we're not really near any of these support levels now on this weekly chart. We're kind of chopping around right now with our long-term equity put call ratio. When this is going down, that's positive. When this goes back up, that's more negative. We're also chopping around here when we take the VIX and then a 3-month average of the VIX and then turn that into a ratio. When this is going down, that's more positive. Now it's starting to tick back up. Then our different charts. We're still looking good on a trending basis with the Heiken Ashi. We're positive even though we're pointing down with the Kegi chart. We're positive with the Renko chart, and we're positive with the 3-line break chart. The trend is still positive. The ease of movement, we're above zero. Even though we did decline, we are still positive here. And we're still looking positive here with the point and figure. Nothing new was drawn. There's no warning signs. We are seeing a warning sign on the daily point and figure chart that maybe suggests that we've gone up too far too fast. That's like too positive. When we look at our momentum, we're still looking good in the long term. We're starting to turn down in the intermediate term. We're positive, but we are declining in the short term with our PPO studies. And then we did start a new 50-day cycle that came in on March 21st, where it looked like, okay, maybe we're going to go up. Now it looked like maybe we're going down, but nothing has really been decided with this yet. We are still neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We have switched to negative on the daily chart. So this is a non-confirmation. Then we are in the month of April, which tends to be more positive, at least seasonally. And then looking at the S&P, which is coming off of recent all-time highs, the mid caps also strong, but pulling back. The small caps are still the lagging index. The Dow continues to be in an uptrend. The NASDAQ is also in an uptrend. The NASDAQ 100 is also in an uptrend. And here's another look. We're kind of going sideways here with this weekly chart, but it's still in a longer-term uptrend. The mid caps continue to be pretty strong right now, even though they pulled back. It's the small caps that are lagging, even though they're in an uptrend on the daily chart and on the weekly chart here. The NYSE is also in an uptrend, a broader measure. The Wilshire, another broader measure, also in an uptrend. All stocks pulled back a little bit, but still in an uptrend. Vegas software companies still have a ways to go to get back to the all-time highs, but in an uptrend. The FANG index going sideways these days is the Magnificent Seven are having, we have, what is it, Tesla, Google hit an all-time high, and Apple is in a downtrend, and I forget the other one right now that I'll remember after I finish recording this. ARK is still in an uptrend, but really has not been participating in the upward move. The bank index, want to keep an eye on that. We're looking good on a momentum basis. We're coming down after being extreme positive with the RSI. The deposits, we want to keep an eye on that. And there's money going back into banks again. That's just showing a little bit more confidence where we had been seeing some real outflows. Here's Dow theory on a weekly chart where we're just recently setting all-time highs with the Dow. The transports are not there yet. We're still in a longer-term downtrend with the utilities, and they're underperforming. The CRB, this is another area that may be shifting over if we're going into a phase where it's okay for value to go up and growth going up at the same time if interest rates are coming down. Commodities may actually get into some bull markets as well. And so we've been seeing the CRB index actually give us a golden cross recently. Oil, this is more geopolitical, and it's getting up almost to 87. Copper, this is also a barometer of the economy. It's looking positive because economically we're looking good. The dollar has also been seeing some strength, and we're just getting ready to see a golden cross here. We've already generated a golden cross on the daily chart, so that's in an uptrend. This one is very close. Gold, and this, you've got gold people that have just waited for this for decades, and now we're finally starting to break out here and setting all-time highs with gold, and now they're just sure it's going to go to 1 million. Silver has also been bouncing back lately, but hasn't been able to get back to previous all-time highs. And we're seeing a cross here, a golden cross. Looking at interest rates, kind of going sideways, but still in an uptrend with the total bond ETF. Stocks are still outperforming bonds longer term. When we look at the monthly chart, we're still positive here when we take the 1 month and subtract the 3-month yield. You would think this would go negative at some point, but it just is not doing that. Here's a daily chart of the yields where they've been chopping around quite a bit, going down, coming up, and then we were up in Friday's session. This is a weekly chart where we still have the US and UK rates at the top, followed by German rates and Japanese rates, and all of them advanced this past week. This is a chart that I've been showing since last October, where we topped out at 5% with the 10-year yield and then started to come down. We're still below that now. Other times when something like this happened, it was usually a negative event. We don't know. It hasn't played out yet. There's been other times when this chart spiked and went down and it wasn't an event. So we're just keeping that in the back of our mind for right now. This is a similar chart. Also, when we topped out here, when we look at real rates, that takes inflation into account and then started to come back down. Okay. Other times when something like this happened, something bad was in our future. Is that going to be what happens this time? So far, not yet, but that could change any day. Then some relative studies. Here's an intermarket analysis chart showing how oil's in the lead. Now gold's in second place, followed by stocks and the dollar, where bonds based on price are down on the year. The ratio from the NASDAQ 100 to the S&P, the bigger stocks have not been performing as well, so that's why we're seeing this pulling back. But in the longer term, the NASDAQ is outperforming the S&P, and both are doing very well by themselves. The S&P 100 is still outperforming the S&P 500, and growth is still outperforming value. Gold is seeing a little bit of a surge here, but when you do a ratio, a long-term ratio with the S&P, it's still in a downtrend. It's going to have to really perform better for longer for this to turn positive. And then gold is also outperforming the dollar. The dollar's been going up, but gold has lately been going up more, and we've actually been able to break above this trend line. Then we look at inverse, where we look at bonds related to stocks, showing how bonds are underperforming. The low volatility stocks are really underperforming the S&P. Even though they're in an uptrend by themselves, you do a ratio, they're in a downtrend and underperforming. Discretionary is still outperforming staples, but we have been really drifting off here lately. Energy is really making a comeback when compared to tech, but it's still in a downtrend longer term. Then our longer term studies. This is the NYSE breadth thrust. We had that signal generated after October 2022, and this is still indefinitely on the books. We also had a ZWAG NYSE breadth thrust. The first signal is pretty much fallen off the books now because it's been about a year. We had another one triggered last October, and that is still on the books, and that has a very good track record going forward. The Zohar check is still positive on a full-on buy signal. That's also very long-term. There's a long-term chart going back to the 87 crash. We're still well above it for the S&P on a weekly chart. And this is a further blow-up of that, just going back to 2018, where this, if we really start to go down, this area may end up providing support. The new highs, new lows for the NYSE, this is still going up. So that's a broad market positive indication there. When we just look at the S&P 500, this is coming down a little bit, but we're still well above zero and going up. That's also positive. The NASDAQ 100 is still above this long-term trend line going back to 2009. Here's the ratio that the perma bears are just salivating over. We're not really seeing much of a change now. This is the NASDAQ 100 growth versus the Dow, which are the best of the best stocks, at least they're supposed to be. And once we hit this level, we were supposed to turn and just go in the toilet. We've been dancing around this ratio level now for quite some time. This is similar where we look at the QQQs and the small caps, where we're coming off of a high reading, but not really starting any kind of a significant downtrend, at least yet. The new highs, new lows, cumulative for the NASDAQ, continue to go up after they had been declining for years. That's positive. And we're still keeping an eye on this 3-month yield. It's going pretty much sideways now. If something happens, something catastrophic, where they have to cut rates, this is going to come down, and it's going to come down fast like it did in 2007. Nothing's happened to this point to make that change, at least for now. Seasonality, and this at least you can jimmy around the numbers a little bit. And I have a chart. I'm not sure if I have it in this video or the daily video, but we just have not been following seasonality. We should have seen a real decline into about the middle of March and then a bounce up. We just went straight up. And so where are we here? We're not really following the historical seasonal norms that we usually see. But we are following this still. 1982, and then we bounced up and then had a real good run after that. 2023 went down, bounced up. We're actually outperforming this now. Then I just got this before I started recording. This is for April. This is Tom Bowley from earningbeats.com. He also posts for stockcharts.com, where April is a bullish month. The not so hot sector are the industrials, which have been doing pretty well lately, and energy, which is hot, which he thinks may even get hotter, according to his research. The first part of the month tends to be positive, so we still have some time here. Then we hit a weak time, and then we tend to see some more strength going into the end of April. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend. If you want to contact me, here's an email. Unless you want to leave a comment. If you want to keep it more private, just send me an email. And have a great weekend, and I will talk to you in the next video.